Corporate and government bonds have a position in the investment portfolios of all investors, from novices to retirees. Fixed income investments, such as government and corporate bonds, can offer a constant, predictable source of income, typically with less risk than other investments. Fixed income investments, along with equities and stock mutual funds, form the backbone of a well-diversified investment portfolio. What are fixed return investments? Fixed income investments, unlike many other categories of investments, do not need to be sold to generate a profit. Bonds are essentially a loan from you to a corporation or government that pays interest over time in addition to the principal balance at the end of a specified period. For instance, if you purchase a bond with a face value of $5,000 and a yield of 3%, you will earn $150 per year for 10 years. This interest can be paid at various intervals, including monthly, quarterly, and semi-annually. After 10 years, you will have earned $1,500 in interest, and the government or company will also have repaid the $5,000 principal. You are free to use the periodic interest payments from fixed income investments as you see fit. However, these payments will be taxed as income, although there are numerous nuances to consider. One essential point. Similar to stocks, bonds can be purchased and sold on the secondary market, which is accessed by the majority of investors today via an online brokerage. The value of bonds on the secondary market may be greater or less than their initial cost. It is possible to sell a fixed income investment for a profit on the market, although investors typically seek the regular distributions rather than the capital gains. Why should a portfolio include fixed income investments? In addition to providing a consistent source of income, fixed income investments are essential to any portfolio for a number of reasons. Diversification is intended to reduce the volatility of your portfolio's performance by distributing risk. This can be achieved by investing solely in equities. Investing in various companies from various industries is a form of diversification, but fixed income investments provide even greater stability for one primary reason. The bond market typically moves in the opposite direction of the stock market, in part because investors view bonds as a secure investment during volatile times. More on this later. Therefore, if the stock portion of your portfolio is down 10% while the bond portion is up 4%, and your portfolio is comprised of 50% bonds and 50% stocks, your aggregate loss is only 6%. Brett Kopel, a certified financial planner in Buffalo, New York, and the proprietor of Eudaimonia Wealth, advises investors to consider fixed income investments as shock absorbers for market declines. During periods of stock market volatility, fixed income typically maintains or even increases in value, explains Kopel. By diversifying your possessions across different asset classes, you will be in a better position to take advantage of rebalancing opportunities to ensure that your money is aligned with your life and the goals you hope to achieve through investing. How do you determine the optimal mix of equities and bonds? According to Kopel, there are two primary factors to consider when determining the allocation of your portfolio: how fixed income comes into your overall financial picture and when you plan to use it. As retirement approaches, advisors typically recommend allocating to fixed income investments. By doing so, you will reduce the risk of market turmoil causing your portfolio to suffer a large loss at an inopportune time. Bonds are typically less risky than stocks, but there are a few dangers to consider. When purchasing bonds, consider the issuer's creditworthiness. In other words, what is the likelihood that the government or company will repay your debt? If the issuer declares insolvency, interest payments will cease and it is possible that you will not receive your principal in full. Checking an issuer's credit quality ratings with companies such as Moody's Analytics and Standard & Poor's can reveal information about its creditworthiness. Investment-grade bonds are those with a credit rating of BBB or higher, Standard & Poor's, or BA or higher, Moody's, and the lowest probability of default. In contrast, bonds below this threshold are classified as high-yield bonds, also known as junk bonds. According to Kopel, this is not a significant risk for U.S. government bonds, but it should be taken into account when purchasing corporate bonds. With corporate bonds, there is a trade-off between the amount of interest you receive from a bond and the perceived creditworthiness of the issuer, or the likelihood that the company repays your full investment, Kopel says. High-yield bonds pay a higher interest rate than investment-grade bonds because the issuer is more likely to default on its debt obligation. In such a case, you may not obtain the full value of your initial investment. The majority of a bond's value derives from its predetermined, periodic interest payments. Nonetheless, if overall interest rates increase, newly issued bonds and their higher interest payment will become more attractive, thereby decreasing the market value of older bonds with lower interest rates. When interest rates decline, however, newly issued bonds will offer reduced interest payments, making older bonds, whose payments are now higher than those of the new bonds, more attractive. Bonds may be less hazardous than stocks, but they do not typically offer the same returns. Initially, investors allocate a larger portion of their portfolio to stocks, then progressively shift to bonds as they approach retirement. As retirement approaches, this strategy maximizes long-term growth while minimizing risk. Even with meticulous savings, a portfolio consisting solely of bonds may not be sufficient for retirement. There is a vast selection of fixed income investments, but the most prevalent are described as follows. Treasuries are the federal equivalent of municipal bonds, and they have dominated the U.S. fixed income market since 2012, accounting for approximately 37% of its total value in 2019. The United States government issues and backs these investments, which come in three forms: notes, bills, and bonds. The greatest distinction between these three is the time required for each to attain maturity, as described below. Bills, maximum of 1 year; notes, 2, 3, 5, 7 or 10 years; and 20 or 30-year bonds. The risk of the U.S. government defaulting on its bonds is essentially non-existent, ensuring that bonds remain a safe long-term investment with consistent returns. Similar to Treasury bonds, municipal bonds are issued by state and local governments. They operate almost identically, but frequently come with an added benefit: federal tax exemption. Municipal bond interest is generally exempt from both federal and state taxes, though this varies from state to state. However, their yields are typically lesser than those of other types of bonds. These are frequently suggested for investors in high tax brackets. Municipal bonds are typically low-risk investments because municipalities can levy new taxes to repay bondholders. From 1970 to 2016, the default rate on 5-year municipal bonds was only 0.07%. If municipal and government bonds offer the lowest risk and lowest return among common fixed income investments, corporate bonds represent the next move up in terms of risk-reward. These investments constitute approximately 21% of the U.S. fixed income market. Corporate bonds function similarly to Treasury securities, except that you are lending to a corporation rather than the government. In general, your investment will be safer the more secure and established the company is. Highly rated companies are the least likely to default on their debt, making their bonds strong candidates for reliable fixed income vehicles. As you climb the risk-return ladder, you will encounter high-yield bonds, also known as junk bonds. These fixed income securities fall below the investment grade threshold established by credit rating agencies. However, as their name suggests, they typically offer higher interest payments in exchange for greater risk. Despite their unflattering moniker, high-yield bonds comprised 5% of the fixed income market as of December 31, 2018. Bond funds bundle multiple categories of bonds into a single basket, thereby increasing the portfolio's diversification through a single investment. Taxes on investments with a fixed income vary, but these differences are relatively straightforward. The following table is organized according to the form of security, the state and federal taxes on interest payments, and the capital gains taxes you would incur if you sold the bond prior to maturity. Pause the video here to review this table. Ready to start generating fixed income? This is how. Purchasing newly issued U.S. Treasury securities is most convenient through treasurydirect.gov. Municipal bonds are available at the majority of the main online brokerages. Investments in corporate and high-yield bonds can be purchased through a brokerage account. After establishing your account, you can use the screening tools provided by the brokerage to locate the bonds that best suit your situation and portfolio. To purchase or sell bonds on the secondary market, a brokerage account is required. What percentage of your portfolio is in fixed income investments? Leave a comment below. Don't forget to like, comment, share, subscribe, and hit the notification bell so you'll know when a new video posts. Take care and remember that your money matters.